Imagine you have a list of stocks you want to buy, but you might not be able to afford to buy every one. So, one option you can consider is an exchange-traded fund, or ETF.
ETFs have changed the game of investment landscape. ETFs are like a shopping basket at the supermarket. One basket, many ingredients, and high-quality ingredients. That's the power of an ETF, because it's accessible, it's at relatively lower cost, hence affordable, and it's transparent.
ETFs actually give you a form of instant diversification, so that might be more cost-effective for a long period.
ETF can also be a great way, as a building block to build out a diversified and complete portfolio as well.
An ETF is a product that tracks a specific index or indices. By investing in an ETF, you are tracking the performance of a specific group of companies instead of a single company. For example, an S&P 500 ETF tracks 500 of the largest companies listed on stock exchanges in the United States. There are now over 14,000 ETFs globally. So how do you pick the best one for you?
They might start by asking a few key questions actually. What's the time horizon, number one, which means are you thinking short-term or long-term? Number two, what's your comfort level with risks? Are you able to weather the up and downs of the market for how long? And number three, what are you hoping to achieve? Mainly, is it growth? Is it income? Or is it stability? Now, these questions can help investors really define their strategy and filter down to the asset class and the corresponding ETF that will help align with those goals. The conservative investor will find that that package portfolio will have a few more bond ETFs than equity ETFs. And then on the other side, the aggressive investor will find that you will have more equity ETFs, you will have more currency exposure as opposed to, say, bond ETFs.
There are a few factors to consider when it comes to picking an ETF.
Number one, ETF performance. Does the ETF give you the returns that of the index it's meant to track? For example, there can be two same index tracking ETFs. Do they deliver the same total returns in that sense? Secondly, the provider, in terms of reputation and reliability, is another important factor. Do they have the market expertise and experience to invest into that market that you've chosen? And do they have the systems to support the tradability of the ETF? Third, cost. Right? Cost is paramountly important for every investor to bring down. Look at expense ratios, for example, look at management fees, and also look at the cost of trading in and out of the ETF.
While ETFs are relatively low cost, they aren't no cost. These costs are known as the total expense ratio, and they will have an impact on your returns. For example, if you have $5,000 invested in ETF A with an expense ratio of 0.04%, you'll pay $2 annually and $20 over 10 years. But if you had invested the same amount in ETF B with an expense ratio of 0.08%, you'll be paying twice as much. These fees come out of your investment returns. Where a fund is based also has an impact on your returns.
Given approximately 60% of ETFs today are domiciled in US and Europe, not necessarily in Singapore, it pays to just look at where that fund is domiciled from, as any tax implications could eat into your fund returns.
For Singaporeans, they are most likely to get taxed for dividend income. So a common option that a lot of investors do is to actually invest maybe in a Irish domicile S&P 500 fund, let's say, where you're taxed less on the dividend. In general, a lot of these funds might come in at having a higher expense ratio than if you were to buy a US domicile fund. So you have to think about weighing those costs and benefits of having each option.
You can find out where a fund is domiciled by looking at its International Securities Identification Number, or ISIN. It is a 12-digit alphanumeric code that uniquely identifies a specific security. The first two digits of the code specifies the country where the fund is domiciled. Other than the low-cost structure, one big advantage of ETFs is instant diversification of your portfolio.
If you buy the S&P 500, you're getting a slice of all the 500 companies in one single trade. That benefit is even more compelling for bond ETFs, which means bond ETFs are making access to the bond markets a lot easier for investors today. And they can give you exposure to entire bond markets containing thousands of bonds within them, be it treasuries like government bond markets around the world, or corporate bonds, or even Asia high-yield bond markets in that sense. Also, worth considering things like other asset classes such as commodity ETFs as well, which are like gold, oil, and silver.
The majority of ETFs are passive and follow a stock market index. So, if the market that a particular fund is tracking takes a dive during periods of volatility, so will the portfolio's value. But active strategies are increasingly being used to add portfolio stability while generating potential returns. Some active ETFs generally come with higher costs.
We're seeing more volatility. Conversely, actually, active management, maybe through some of these actively managed ETFs, might add more value because the portfolio manager can then sift through the market, go through the stocks to see which stock fits the current environment, for example, right? And maybe go a bit more defensive if the call comes. So actively management funds, ETFs, can add more value in kind of rough environments. So I would say fees-wise, it would sit somewhere between where passive ETFs and fully active mutual funds are. So somewhere in the middle, but closer and passive. So fees will still be meaningfully lower than typical mutual funds.